You know, in the world of business, we're constantly making decisions. But what if the very tools we're using to figure out what's profitable or, well, what if they're broken? What if they're leading you down the wrong path? Today, we are going to break down a really powerful framework that's designed to help you make smarter, more profitable choices every single time.
Okay, so let's jump right in with a classic situation. A brand new client comes to you with a huge, one-time order. Sounds great, right? But here's the catch. They want a pretty steep discount. Your gut might be telling you, yes, look at that volume. Or maybe it's screaming, no way, the margin's too thin. It feels like a simple yes or no, doesn't it? But as we're about to see, the real answer is hiding in the details.
And this right here is where so many businesses get it wrong. See, if you're just relying on the usual standard accounting metrics, you could be walking straight into a trap. These older methods are just too simple, really. They can trick you into taking deals that are secretly losing you money, or, just as bad, they can make you turn down opportunities that would have been absolute home runs.
So to avoid that trap, we've got to get really surgical about how we look at our costs. And that means we have to start with a whole new way of thinking about them, one that goes way beyond what you might have learned in a textbook.
A lot of us were taught to look at something called the contribution margin, your revenue minus your variable costs. And look, it's a decent start, but it is dangerously incomplete. The real game changer is this idea over on the right, the differential benefit. Look closely at the difference. We're not just subtracting variable costs. We're subtracting all costs that change, specifically because you make this one decision. It's a much, much more powerful and accurate way to see things. So what are these differential costs exactly? Well, think of it this way. They are any and every single cost. It doesn't matter if you normally call it variable or fixed, that you only have to pay if you say yes to this deal. We're talking beyond just raw materials. It could be the cost of extra setup time, a special software license you need for this one job, or even hiring a temp. The test is super simple. If you don't make the decision, does the cost disappear? If yes, then bingo, it's a differential cost.
Okay, that's a great concept in theory. But let's be real. In a complex business, how on earth do you actually track down all of these costs? How do you make sure you don't miss something really important and mess up the whole calculation?
Well, the answer is this really clever tool called a hierarchical cost map. To make it simple, imagine your business is a bakery. At the very bottom of this pyramid, you have the entire plant, the bakery building itself, the rent, the big utilities. A level up from that, you have a specific production line, say for bread. Then a level up from that, a single batch of sourdough, and at the very top, one individual loaf. This map is what lets you see exactly where a decision actually makes a ripple.
And here's how you use it. First, you map out all your costs, just like we did with the bakery. Then, for that big discounted order, you ask yourself, what is the lowest, most specific level that this decision actually touches? Let's say it's the batch level. Now here's the crucial part. Only the costs at the batch level, and everything below it, in this case the unit level, actually matter for this decision. All the costs higher up, like the production line and the entire plant, they're unchanged. So for this calculation, we completely ignore them. Pretty clever, right?
All right, so once we've identified all the resources we're going to use, we have to put the right price tag on them. This little table shows you the 3 ways to do it. If you have to go out and buy something new for the order, you use its current acquisition cost. Simple enough. Now, if you already have the resource sitting in your warehouse, but you could sell it to someone else, its value is the net realization value. That's the money you're giving up by using it. And finally, if you've got a resource that has no other use and you can't sell it, its value is 0. It's a sunk cost. It's already spent.
And you can see how all this is starting to build a very special kind of income statement, one that's just for this single decision. We've got our net revenue from the deal, and now we can subtract our true differential costs. That leaves us with our first major hurdle, the differential benefit. The first question is this number positive? But wait, don't say yes to the deal just yet. We're not done.
Because now we have to ask another really critical question that most traditional models just completely ignore. How busy are we really? And this brings us to what's called the high capacity test.
The logic here is incredibly simple, but it is so profound. If your factory has a bunch of idle machines just sitting around collecting dust, then pretty much any project with a positive differential benefit is a good thing. But if you are already running flat out at full capacity, saying yes to this new discounted project means you have to say no to something else you're already making.
This image shows it perfectly. Your machines are humming along, making your core money makers, product A and product B. Then, this new opportunity, product C, comes knocking. To make room for C, you have to stop making some of A or some of B. And the profit you would have made from the products you had to displace, well, that's the opportunity cost of using your busy machines for product C.
So, here's the rule you need to remember. When you're at low capacity, your opportunity cost is 0. Go for any deal that shows a positive gain. But when you're at high capacity, the whole game changes. That new project's differential benefit has to be bigger than the benefit of what you're giving up. It has to be the absolute best possible use of your limited time and resources. And now, we can add this second critical test to our decisions income statement. The differential benefit that we calculated before, it has to be greater than the opportunity cost of using that capacity. If it's not, then even if the project looks profitable on paper, it's actually a bad deal for your business right now, because you could be making more money doing something else. Okay, there is one last really strategic layer we need to add to all this, because, not all business is created equal. We have to be able to distinguish between our core, long-term business and those one-off opportunistic plays. So we can classify basically every decision as either structural or marginal. Structural decisions are all about your core business, your main products, your key clients, the stuff that keeps the lights on. These deals have to pull their full weight. They absolutely must cover all costs, direct and indirect, and hit your target profit. Marginal decisions, on the other hand, they're more opportunistic, temporary, maybe to fill some idle capacity. Their job is much simpler. They just need to generate a positive return.
So how do you put this into practice? You use this matrix. It's actually pretty straightforward. For any deal that comes your way, you classify 3 things. The product itself, the client, and the market is either structural or marginal. And based on how you classify them, this grid will tell you exactly what level of profitability you should be demanding from this specific deal. And this matrix gives us 4 really clear rules. Rule 1 is your bread and butter, your core business dealing with core clients. It has to support the whole company. Rule 2 is when you sell a core product to a non-core or marginal client. Here, you want the same profit plus a premium, and that's to protect your pricing with your most important customers. Rule 3 is for a marginal, one-off type of product. It just needs to be profitable on its own. And Rule 4, that adds a premium back in, again, to protect your core relationships.
And here it is. This is our completed framework, all on one page. After a deal has passed the differential benefit test, and after it has passed the opportunity cost test, we apply our final check. Is the benefit big enough to cover its required share of the company's overhead and deliver the target profit we just figured out using our matrix?
So let's put this all together. Let's recap what this new, much smarter decision framework looks like from start to finish.
Really, it boils down to these 4 critical steps. First, forget contribution margin. Always calculate the differential benefit. Second, use that hierarchical cost map to find your true, relevant costs for the deal. Third, if you're busy, you have to make sure the deal clears that opportunity cost hurdle. And finally, fourth, use the strategic matrix to set the right profit target, depending on whether the deal is part of your core business or just a marginal opportunity. When you get right down to it, the whole philosophy behind this model is captured perfectly in this quote. It's all about having a framework that's sophisticated enough to be precise, to treat deals that are fundamentally the same in the same way, and maybe more importantly, to treat deals that are actually very different. So, I'll leave you with this question to think about. By relying on those old, simplistic, one-size-fits-all metrics, what hidden profits are you leaving on the table? And what unseen losses might you be taking on without even realizing it? This framework gives you the tools to find out.